Today's the day. Again, looking for 7,000, 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
We have a continued spending spree for big tech. Meta, Microsoft, and Tesla ramp up investment in AI. Now attention turns to Apple after the close.
Blackstone delivers a surprise jump in profits. President Jon Gray says deal-making has reached escape velocity.
And packaging giant International Paper plans to break up and spin off its European operations.
A lot of stories to cover today, a lot of corporate news, and we're excited to bring you some exclusive conversations on that front. But Matt, I'm kicking things off with a look at Microsoft. You mentioned the huge amount of AI spending that we're getting. At least when it comes to Microsoft, investors are worried. Down 6.8 in the pre-market. Cloud sales growth slowed last quarter, and its outlook was seen as weaker after spending a record $37 billion in the past 3 months. It's a market that's upset about this now. You can't just spend and expect gains.
Well, CapEx is up 66% in the quarter, and revenue from the cloud, at least, only 38%. So there's a bit of a mismatch there. Meta's ad business showed improvements and will help the company spend up to $135 billion in CapEx to fuel Mark Zuckerberg's ambitions of AI super intelligence. You can see the market likes this, up 10%. But of course, they're making the run rate for their ad business is like $220 billion a year. So they can afford it.
Exactly. It's the divide. Can you afford to keep spending or can you not? And let's discuss just that in the rest of the Mag 7 earnings we've been getting and will get with Bloomberg Tech co-host Ed Ludlow. Ed, how did you distinguish between how the market treated Microsoft earnings versus Meta earnings?
Yeah, like Matt has the right formula. Expenses growth for Microsoft is outpacing growth in the key unit that we track, which is Microsoft Azure, which at 38%, like 38% growth is nothing to sniff at, but on a currency fluctuations adjusted basis was completely in line with consensus. And even like I think on your program, right, people have been coming on to Bloomberg Television and saying they want to see Azure at 39, 40% growth. But the reality is that it's now decelerating a little bit, going in the wrong direction. Compare and contrast, like Meta projected great confidence saying that capital expenditures at the top end will be $135 billion this year. That's a ginormous figure. But in the current period, at least, in the forward-looking commentary that they gave, ad sales growth is very strong. Meta, a little bit differently, gave other data points that also showed that internally, all this AI prior investment is paying off for them too. They're just better at doing certain core functions.
You know, I talked to a trader this morning, Joel Colina from Wedbush, who said he's a little worried about companies close to OpenAI because their cash burn is so high. Right. But I noticed OpenAI contributed $1.02 to Microsoft's bottom line, and that's more than 25% of their total earnings.
Right, so they contributed $1.02. How much of that $1.02 did Microsoft give OpenAI in the first place?
Good point. The circular economy.
Right, and you know this is like a well-discussed thing. There are two parts to it. That circular financing element is very true. OpenAI is also almost a burden to Microsoft. Microsoft is capacity constrained. It has to deal with the infrastructure of OpenAI's activity. But also, like Microsoft, you know, I grew up with Microsoft as a kid, right? In those days, you would pay for your Office 365 subscription, software that you could get elsewhere for free otherwise. In present day, it's not just OpenAI, but Anthropic as well, offering tools that basically make enterprises look at their software expense and say, is this something that I actually need right now? You know, there's choice in the market.
Hey, Ed, quickly before we let you go, we're also going to get Apple earnings on deck. I got to wonder, with the nerves around spending, does Apple become the winner that they're adding Gemini to their iPhone? Users will get AI exposure and AI assistance without the hundreds of billions of dollars committed to AI-related CapEx.
Yes, and also Apple just doesn't rise and fall on a capital expenditures figure, right, like the hyperscalers do. The data out of China in particular looked good in the prior quarter. The soft data points us that this will be a record quarter for Apple, right? In the background, memory pricing is severe. And so Apple's management of that supply chain, the bottleneck of memory, but also what to do with passing on pricing, that might show up. And so that management, you know, Apple's the king of managing the bottom line. But that is something to pay close attention to for sure.
All right, we will be paying close attention throughout the day, and tune into your show as well. Bloomberg Tech's Ed Ludlow, he kicks off his program at 11 a.m. Right now, let's get into Tesla, because those earnings topped estimates for the fourth quarter, and the electric car maker said it will invest $20 billion to ramp up production of not just cars, but batteries and robots across half a dozen plants. Here's Elon Musk.
I think in order to remove the constraint, the probable constraint in 3 or 4 years, we're going to have to build a Tesla Terafab, a very big fab that includes logic, memory, and packaging domestically.
Joining us now is William Blair, head of energy and power technologies. Jed Dorsheimer, he has a market perform rating on Tesla. Jed, what did you think of the earnings? What do you think of the CapEx plans?
Well, I think thanks for having me. I think there's a little bit of both. You know, the bulls are going to point to autonomy and humanoid robots. You know, the end of life for the S and X for the humanoids is going to be a signal of this is the future. And they're not wrong. I mean, that's where most of the value from a stock perspective is in these future opportunities here. The bears are going to say, wait a minute here. You've got, you know, auto that's doing worse. You're now end of lifing, you know, part of that. Where's the cash flow going to come from to pay the $20 billion of CapEx that they just announced and $2 billion that they're investing in XAI? And then quietly in the middle is kind of the area that we focused on is the energy business continues to march along is kind of the silent success here, which we're going to need more and more of. So I think, you know, you're kind of in this in what I would call a tweener category where it's like, hey, you know, those who have made up their mind or on the bull side are going to point to that. I don't think this quarter is going to really change anyone's minds here. And you're going to need to, you know, we're going to need to see if Elon can hit timelines, which historically he's not been good at, but you know, as we can see those data points around automation and autonomy and robots, that could drive further upside.
Jed, can I get your thoughts on that? What you bring from what the bears would be worried about? Your direct response to those who say, as you put it, they now have a cash flow problem if they're putting their EVs aside and investing into AI and their humanoid robots. How do they solve the cash flow issue?
Well, Tesla's, I don't think so I would come back and so part of the bear story is that we're in a cyclical versus secular trend here in terms of AI. We see AI as existential. We see the move to, you know, the need for more power as we reshore and kind of increase the energy density per dollar of GDP. And so, you know, I see that as something that we have to move towards, and AI becomes your disinflationary hedge against that. So I think at a fundamental level, the bears have it wrong because it's like we're applying, you know, oh, this is 2000 all over again. And I don't think that's the case. As for Tesla in terms of cash flow, you know, as the energy business continues to march along and recognize that the 3 and Y make up most of the auto sales, you're not really giving up that much with the S and X. And, you know, if you can hit the numbers on the, you know, the robots and you bring down pricing on that, that demand, you could actually have more cash flow that comes into the business from that trade. So that's how I would address that, the bear side of that story.
You do give up what I think is the most elegant, most successful, most enduring design in Tesla history. I mean, the Model S, Franz von Holzhausen, turned out in that an all-time classic. Does it matter if Tesla comes out with any good cars anymore? Because everything else is pretty boring.
It's not an auto story anymore. I mean, it's sad, like you'll lose sexy, right? That was, if you look at how the S, the E was for the 3 and the X and the Y, but it's not a car story. And I don't think it ever was. I think that was the petri dish to kind of prove out the hypothesis here. And it's really been, in our opinion, an energy story, and that might be transitioned to more of an information and automation story. So those who look at it like as a car company and say, hey, I want to comp it to a General Motors or Ford have always gotten this wrong, and they've been crushed on that trade. And I think they will continue to be crushed. So,
Jed, then take us to this future when it's no longer, I guess you're saying it's no longer a car company now, but with the EVs it still have left, what does Tesla look like, let's say, in 5 years' time? Is it just not even producing vehicles anymore?
Well, we've argued strongly that the return on invested capital for the energy business is far greater than that of the auto business. And we're now seeing that in terms of what's needed. If we look at every gigawatt of compute that's going into a data center, you need 2 gigawatt hours of batteries. And so your return there is tremendous. We're short 90 gigawatts of power by 2030 in terms of data center demand. So it's an enormous amount of energy that can be supplied. And I think this is a really elegant and critical solution for that. In addition, once you get to autonomy, their cost structure of their tech stack is far lower than that of Waymo. So if they can, as long as they don't have a major incident and they are able to continue to scale robo-taxis, then they can use pricing as a weapon to come in well below what you'll be able to do in terms of Waymo with Uber. And so that presents an opportunity to take that market share. And, the average utilization of a vehicle is only 5%. So as you go to a robo-taxi, your utilization goes up to, 80, 90%. And so you'll need less overall vehicles, but the usage model changed dramatically. And so that also gives them a huge advantage there. So, those are sort of the winner-take-all opportunities that they're going after. Now, in fairness, we do not have Optimus in our model, and most other analysts don't. So that's an upside opportunity is that flows in.
All right.
That's a little picture of the future.
I'm looking forward. That's the part I can't wait for as Optimus. Jed, thanks so much for joining us. Always a pleasure having you on. William Blair's Jed Dorsheimer there. We'll discuss big tech's spending spree in the next hour as well with Sadek Wahba, an investor in infrastructure. I'd say one of the most famous infrastructure investors there. He started that business at Morgan Stanley. Now he's at I Squared Capital. Quick check on futures right now. We're looking at S&P futures up just 0.1%, but 7,017 the level there. If you take out the premium for futures, we're looking at about a 7,000 even cash open. Nasdaq really not moving at all. 26,164 on the Nasdaq. No, we're going to have Adena Friedman on.
Correct.
Which
Nasdaq,
I'm very much looking forward to.
On Nasdaq earnings.
I was looking at the Nasdaq composite from the high in March of 2000. It took 15 years to get back to that high of 5,000 roughly in 2015. But now we're at, 5 times that amount.
Yeah, and by the way, Nasdaq shares themselves are at a record high too. I think around $100. So a nice round number for them too.
All right, coming up, another stock on the move, International Paper. Those shares climbing after announcing plans to split the company into 2. We're going to speak with the CEO next, Andy Silvernail. This is Bloomberg Open Interest. Let's get to high interest now. Look at what's making headlines around the world. Brent crude hit $70 a barrel for the first time since September after President Trump warned Iran to strike a nuclear deal or face possible military action. The threat added a fresh geopolitical risk premium to oil, with analysts estimating prices are $3 to $4 higher on Iran concerns alone. Meanwhile, fears of supply disruptions in the Middle East are outweighing expectations of global oversupply. And Dow says it will cut about 4,500 jobs worldwide as it shifts more operations towards AI and automation. The chemicals giant expects up to $800 million in severance costs as it streamlines and simplifies its business. The move follows earlier layoffs and plant closures and comes amid a broader wave of job cuts across major U.S. companies as hiring slows and worker anxiety mounts. The Fed didn't seem to see it that way yesterday. But International Paper says it will split into 2 publicly traded companies, spinning off its European packaging business. The move follows last year's acquisition of DS Smith and comes as the company looks to simplify operations and improve performance after a tough year thanks to trade uncertainty and weak consumer sentiment.
Well, Matt, I am pleased to say that joining us now is the man himself, the International Paper Chairman and CEO, Andy Silvernail. Andy, thanks so much for joining us. Exciting news, not just on the earnings front, but on this deal to split into two. As Matt mentioned, this comes about a year after your acquisition of DS Smith. What was the calculus of rather than work on continue to integrate that versus splitting apart into two companies?
Yeah, well, thanks for having me here this morning, Dani and Matt. And really the impetus here and the exciting part of this is what we realized is what we have are two regional powerhouses in sustainable packaging. And as we dug deeper into the businesses, it just became more obvious every day that all of the value was in those regional integrations. And that's really what drove this decision making. It's an exciting day here for International Paper and the opportunity to leverage those two powerhouses by focusing on capital allocation that's really unique to their missions, to be able to drive the focus. As you know, 80/20 is really how we work in this company. And that really says, hey, let's simplify the businesses, let's segment them, let's focus resources on what drives the most value and allow those businesses to thrive and become best in class in their markets.
To what extent did tariffs, Andy, or trade uncertainty, the changing geopolitical landscape have to do with this decision? Because at first glance, to the layman, it looks like that could be the motivator.
Yeah, very, very little actually. At any point in time, you got to think about the geopolitical implications and all of the forces that are shaping the world. But it's a moment in time, and when we're making decisions here at International Paper, we've got to think for the long term. We have to think for generations. And so while that's a factor that you have to consider, it's really around the fact that all of the value is regional. And that's the really important message here is the value is regional. And so let's focus on the customers, their distinct missions, distinct needs. Let's focus on the assets that need to be applied there. And critically, the capital allocation and the resource allocation to allow them to pursue those unique missions.
Andy, another thing that's been weighing on CEOs' minds who have to deal with an international company, a global company, is weakness in the dollar and how that's impacting various FX effects of earnings and revenue coming in. How are you thinking about that, especially with splitting your business into these local divisions?
Yeah, Dani, when it comes down to it, that's really not a decision point in a moment in time. The strength of the dollar in any single period, not really a factor here in decision making. Again, the focus has got to be on the long term, on the structural dynamics of the business, what allows value creation to happen, how customers behave, how the markets behave, and then therefore how we apply our resources to drive value. And so again, you've got to take the time to really understand what's happening in the geopolitical context, what's happening to trade pressures, what's happening to capital flows. But ultimately, again, I've got to be thinking about decades. One of the things that I find really interesting about this business and I love about this business is we have to think long term. The capital investments that we're making, how market structures evolve over time. Those are really long-term plays, and we got to be thinking about maximizing long-term value creation, not short-term gyrations in markets.
You do have, this is a 4-year low, so it's not that short-term for the dollar, and, we're looking at forecasts for it to continue to sink. Nonetheless, it puts you in a relatively good position, right? Because you have something like 65 packaging plants around the U.S. You produce, I think, like 70% of your paper here in America. So as the dollar declines, aren't you able to sell more of it to people overseas?
Well, what's fascinating here, Dani, is because of our name, International Paper, people kind of think of us as a global commodity paper company. And the reality is we are a packaging company, and that packaging business and sustainable packaging is actually very local. So while we manufacture paper in each region, very little of it crosses borders. And so really our paper manufacturing is done in the region. It's then shipped to around regional population densities or MSAs, and then is converted into sustainable packaging. And so in terms of how the dollar affects us, it's really just a translational impact today. And of course, it has implications of how the global economy forms and reacts. But in terms of actually how the markets form and the implications for us as we go forward and as we split into two separate public companies, it's really just going to be the impact that it has on the overall economy, not so much how it impacts international paper.
Well, Andy, thank you for joining us on the day of this deal announcement. Congratulations on it. Enjoy the rest of your, I'm sure, a busy day on this earnings day. International Paper CEO Andy Silvernail. By the way, if you want more deal news, here's something you do not want to miss. The debut of Bloomberg Deals next week, which Matt Miller is probably tired of me talking about.
Not at all.
My new show that tracks the key players, major moves, and capital flows behind global deal making. It's Wednesday, February 4th at 12 p.m. New York time. Clear out your calendars.
No, I'm excited.
Appointment viewing.
I'm really excited about this because, of course, we're going to continue to focus very much on M&A and IPOs
Totally.
and public and private capital and how they interact with deals on this program. But that'll be a great way for people who are specifically focused on that industry to get everything they need downloaded in an hour.
Let's cut this up and use it as a commercial. Thank you, Matt. Thank you for the buzz marking. Coming up, more deals. We're going to listen to my exclusive, or not my exclusive interviews, but one of the many interviews of Jon Gray this morning post-earnings. That's coming up next.
Let's get a look at some of the movers on our radar this morning. Single stock stories start with Caterpillar earnings, topping estimates as energy needs for AI drive demand for its equipment, but tariffs cost the company $1.7 billion in 25.
IBM topped analyst estimates. It is on strong growth, on course for strong growth for its software unit, though shares up 7.6% in the pre-market.
And Royal Caribbean earnings were better than feared, as it says about 2/3 of its 2026 trips have been booked up. I hear John Farrow actually is looking to book a trip, so maybe they get one more passenger from surveillance.
I cannot imagine that. I truly cannot. Coming up, more earnings as we go to the opening bell.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Looking at futures that are a little bit higher, so 7,015 on S&P futures. Nasdaq futures down a little bit now after a slew of tech earnings yesterday, including Microsoft, which disappointed with its cloud growth. The small caps gaining about 0.25%. Down the New York Stock Exchange, super pumped. York Space Systems is ringing the opening bell. Dirk Wallinger right there, the founder and CEO. No tie, front and center. That's how you know he's the founder and CEO, because he doesn't have to wear a tie. PicPay is ringing the opening bell down at the Nasdaq market site. And this gentleman's going to join us right here on Bloomberg Open Interest. CEO comes on to talk about this Brazilian bank. Now, Dani, in terms of the stocks to watch, it does look like Microsoft is weighing down the gains that we should be seeing from Facebook and Tesla.
Yeah, right around new highs for this index. Microsoft is impinging things at this moment. Look at this chunky decline, down 9%. The issue is that its cloud growth slowed last quarter. At the same time, it's upping its CapEx, spending a record amount on AI capabilities. You compare that with Meta, up 10%. It's because their ad business grew, and that's allowing them to spend money, at least $115 billion on their AI efforts. Tesla, as we were just talking in the last hour with William Blair, they are putting aside $20 billion to build out factories for its robotaxis and robotics plans. It's axing some of its older EV models because apparently this is not an autos company anymore, Matt.
Yeah, no, it isn't. It's more, obviously, with a $1.5 trillion market cap. That's more than all of the other automakers in the world put together, including like Pagani and Koenigsegg if they had a market cap. I think the most interesting thing about Tesla, a viewer just sent me a tweet, and I've got to verify this with Modal on the Bloomberg terminal, but looks like free cash flow in the fourth quarter, $1.420 billion. Which is the exact same number for free cash flow in Q4 2022. So Elon Musk loves his 420 references, as do I. Apple reports after the bell, with Wall Street expecting record holiday sales last quarter. Analysts will be closely watching how memory chip costs are impacting the business. Obviously, they've gone up, and they're an important part of your iPhone. So it'll be interesting to see how that hits the bottom line when we see Apple report earnings today after the bell. Don't miss that on the close with Romaine Bostick and Katie Greifeld. Joining us now to talk about S&P 7000 is Citi Wealth Chief Investment Officer Kate Moore. And Kate, I know it doesn't matter for any other reason than the fact that it's a big round number, but I guess a lot of people put in stop orders or sell orders at that level. So when we bounce up against it, there's a little bit of resistance. What do you think about stocks right now?
You know, we're still really constructive on stocks, Matt. And I have to say, it does get a little uncomfortable when you've had a couple of these years of very strong performance, not just in the U.S., but of course, some of the broadening out that happened in 2025. And people want to kind of doubt the sustainability of the run. You know, you've seen this on a couple stocks you were just mentioning a moment ago after their earnings report, that if it doesn't hit the highest bogey or the highest whisper number, people get a little bit itchy. That said, the fundamentals look really, really strong, Matt. And we are very anchored in the fundamentals in terms of our equity allocation. And as such, we are still continuing to have a significant positive view for equity returns over the course of the year.
How then do you kind of say, all right, Microsoft gets slammed because it's spending a lot, but Meta does okay, and it's spending a lot? Sure, the revenues coming in are different, but Kate, how do you distinguish which kind of spending from hyperscalers is okay and which is not okay?
I mean, Dani, that's a great question, because this kind of knee-jerk reaction, like some spending works and some spending may actually be negative for margins in the near term. It feels like investors' time horizons keep shifting based on a specific company. And look, here's what I will say. We want investments to happen at this point, not just in the AI cycle, but of the economic cycle. We think we're in a year of overall spending outside of technology, including in industrials and parts of other resources. And people are going to have to get comfortable. There was a knee-jerk reaction for a very long time that if a company was spending, if their CapEx was strong, you faded that because you were worried about the delivery on the bottom line. But I think we need to have faith that companies do an outstanding job today managing to their margins and managing to their earnings. And even if we have one quarter that looks a little softer, a little disappointing, it's not a reason for us to step back from our positive equity risk.
Do you worry about the concentration risk, especially around one private company? I see people throwing 10, maybe 30, maybe $100 billion at OpenAI. And I'm not asking you to specifically comment on that company, but just the concentration risk. So many companies are so deeply invested in Sam Altman.
Yeah, well, I would say I can't comment specifically on that, Matt, but I do think the concentration risk in a lot of investor portfolios made them uncomfortable over the course of 2025. And some of the rotation that we saw at the end, kind of the last 2 months of the year, was really about this, that not just the US, but certain US companies had become outsized in investor portfolios. And people started to ask themselves, like, does this make sense? Or in the case of some funds, have they bumped up against the position limits they could hold in individual names? So I think we're going to continue to struggle with this when you have these companies that are growing in a phenomenally fast pace, who are like eating everyone else. And as a result, their market cap is reflected in, the outsized positions in an individual portfolio or an ETF or an index. I think that's going to lead people to ask, what else should I be doing to balance that risk? And how can I hedge my exposure to some very concentrated ideas?
Kate, for some people, I guess a lot of people actually, the hedge has become gold. I mean, the price of gold has been remarkable. It's now above $5,500. But Kate, can it act as a hedge when itself is looking like a momentum play? Shouldn't that be a concern? Can it really be a hedge with these types of skyrocketing price moves?
Look, when I added gold to the portfolio last year, and we added, over the course of 2025, it was really kind of the drivers around, the fiscal story and fiscal sustainability. It was a story around, how do we, diversify away from U.S. dollar holdings. It was the central banks continuing to add to gold reserves. And, these kinds of real fundamental drivers. Right now, we are seeing an incredible amount of interest from a wide range of investors in adding gold. And I'd be lying if I said that the price performance this year doesn't make me a little bit uncomfortable. This type of move this fast always gives a little bit of pause. That said, I do think that gold should be an important part of portfolios. We have used it both as a hedge against some of our equity exposure, as a substitution for duration, as what we think can be an uncorrelated source of return. So there's a lot of drivers for that for us in our portfolio construction. But yeah, we're watching for maybe a pause, a bit of breathing room actually after this phenomenal run.
All right, Kate, thank you so much for joining us this morning. We always love having you on. Appreciate your time. Citi Wealth Chief Investment Officer, Kate Moore. About 8 minutes into your trading day, let's get a check on this equity market that is fighting the push and the pull between Meta and Microsoft. Microsoft winning out that battle. We're looking at a one, or actually that's not the S&P. Let's just hold on one sec. We're going to get that up. It still is a push and pull because Microsoft plunging 11% at the open. Let's see where it is now. It's at 10% now. So let's start with the decliners here. Down 10%. NVIDIA, it's only down 0.4%, but because it's so big, we've sorted this based on how much it's weighing down the equity market by market cap. Just on that note, I mean, this is such a good function to have move. 42 points. That's how much Microsoft is responsible for dragging down this index that has been trying to hit 7,000. We are under that this morning because of the weight. Just some things, the upside Meta, we've been talking about this morning. Their spending's okay because the advertising business is healthy. We're going to talk about that after the next break. IBM, they had earnings that they're solid. Caterpillar also had earnings that are solid, as did Royal Caribbean, and some of the other tech names like Alphabet doing well too. Let's look at what the sectors are doing. Tech's going to be an interesting one because of this push and this pull. 2%. Ouch. Again, because Microsoft's down 10%. Meta can't lift that up. A tough day for tech. At the top of the pile, we showed you what some of those energy names like Exxon were doing. So that means that it's moving. The reason Meta's not helping, just thinking out loud here, is because it's listed in this index, communication services. And that's why that's up 2.25%. And tech is down. Industrials, financials, materials, leading out the rest of the pack in this morning's session, Matt.
I want to also add, I can confirm Tesla's free cash flow number was the same as the data point sent in by a viewer. Thank you, Tommy, pointing out that free cash flow came in for Tesla at $1,420 million.
Thank you for bringing us that, Matt. And a very important figure.
I just want it, like the function, MODL on the Bloomberg, right, for any equity. It's such an incredibly good and efficient function that
Do you think Tesla was like, shoot, we're at 419, everybody ramp up the sales, we got to get to 420?
I definitely do. Somehow they massage it in the right way, all the right ways. Coming up, Meta's AI spending is double what analysts expected, but shares are climbing. They like to see that kind of spending. We'll discuss this with Madison and Wall's Brian Wieser next. This is Bloomberg Open Interest.
Let's get you some top calls. A look at what the sell side is saying this morning. First up, Barclays, they upgrade Zillow, saying housing markets can remain nearly stable for the company to execute well. The firm sees solid mid-teens revenue growth, faster profitability gains, and improved execution. Shares are just slightly dropping, though, this morning. BMO Capital Markets, they are downgrading First Solar, saying Tesla's plans to build large-scale vertically integrated solar manufacturing could be a meaningful competitive threat. Shares clobbered, down almost 11%. And to the upside, Meta's strong revenue outlook is easing Wall Street concerns around rising AI costs. JP Morgan said Meta is earning the right to spend as revenue and engagement pick up. Morgan Stanley pointed to the fastest growth in over 4 years, driven by monetization. Shares up more than 7.5%, Matt.
All right, let's focus in on that because joining us for more on Meta is Madison and Wall principal Brian Wieser. And, you know, it's fascinating that the market likes it when they say we're going to spend 85% more than the record spend last year, up to $135 billion. I think, by the way, that's a corporate record for CapEx.
Must be.
I was looking at like Saudi Aramco, their biggest number was $50 billion. And yet I understand it because they made, what, $60 billion in ad revenue in 1 quarter?
This is a $200 billion revenue company, and at the current rate of their expectations, they'll be 250 maybe by the end of next year, which is a stunning number. Still not as big as Google, by the way, but still a really stunning number. The point is, though, that they will claim that the AI investments are allowing them to be better at driving perceived performance, perceived as a key word, They're better at segmenting marketers differently, better at segmenting users, better at finding ways to add to the ad load without maybe people noticing. So there's all sorts of advantages that they get from it, and that's really driving it.
Well, forgive my ignorance. What is perceived performance?
Well, they can attribute a sale based on the idea that you were exposed to an ad. Whether or not you were actually incremental, maybe they were really good at targeting the person who was already going to buy a product.
Yes.
And they get credit for the sale. That would be the perceived performance. They're really good at that. They might drive real performance too.
No, it makes a lot of sense. Like, I am a big fan of flannel shirts, right? And I love this little brand, Outer Known, and I buy stuff there.
Yep.
So as a result, Outer Known ads pop up in my Instagram feed all the time. But I bought the shirt first before the ad popped up, not the other way around.
So Meta knows a lot about you because they're really intelligent in terms of their systems, and they know that you're already buying it offline, let's say. Whether or not you were exposed to the ad may or may not have a factor in driving that. It may have been coincidental, but the attribution tools that they produce, which are really good, might just say that they cause the attribution.
We are getting a lot of, finally, interest. I mean, this is, people have been trying to make wearables for so long, and it feels like it's finally gotten to a point where people are into it. There's been rave reviews of the Ray-Ban Meta ones. The information reporting that Apple is starting to develop like an AI pin. How much does that change the advertising game when they all of a sudden have access to data? That's like literally what you do every day.
It probably doesn't change it much in the near term. It's a little fantastical to think about, certainly marketers thinking about allocating advertising budgets in that manner. That doesn't mean there's not a real consumer product. And unfortunately, thinking about the events of this past week, when you think about how like consumers maybe might think, I think I need to have wearable glasses rather than holding on to a phone. Think about that as a consequence. That could be a catalyst, unfortunately. But I think that the idea of wearables, I think, do have legs in the long term. I know I'm waiting to get some.
Yeah.
But I don't know that it'll drive the advertising business at all.
But does it shift? I mean, if I could wear Meta Ray-Bans, instead of carrying my phone, I would probably use fewer Apple products, right? Does that massive business shift to Facebook?
There's always that risk, and that's also why you could argue OpenAI wants to invest in hardware too, right? They want to have devices. We're not sure in what direction it will actually take, but absolutely. Now, there's a form factor.
That's exciting, by the way, the new device, whatever it is, and we still don't know, right? That's coming out with the help of Johnny Ive.
Exactly. The form factor is something that the world hasn't gotten over yet. Snap's been at this for a decade, right? Spectacles was kind of what the company really wanted to do when they went public in the first place a decade ago. We're not there yet. How long ago was it that IBM had a commercial showing these wearable glasses, right? I still remember them going, oh my God, I want that.
Or the original Google Glass. Everyone was like, you are an absolute nerd and dweeb if you wear these things. I did buy one of the original Snap glasses, though. I remember like queuing up in line on a Snap pop-up in Madison Avenue. I wore them once in San Francisco, and a random tech bro complimented on me, and I threw them in the trash.
I want the LinkedIn glasses, though. I want to go to an event and say, hello, Dani, how is your recent job appointment? I want to be able to look at the...
Spooky, that's spooky, dude.
But I want that.
I know, but what is the line here? Because it does feel like we're getting into very, like, Big Brother, terrifying kind of future.
We're there. I mean, we've blown past that point.
I mean, have we? Are we just deciding that personal, I don't know, like any sort of privacy is just over for us?
I think consumers generally protest and they don't like it when they're presented with the alternative of not having this, but then they're given convenience and ease. And this is the same with advertisers too. They can complain about transparency and all sorts of other problems, but they're given perceived performance, perceived ease, and they take it. This is why you have to look at the European Union, where the basic premise is privacy is like your organs. You're not allowed to sell your organs, and you're not allowed to sell away your privacy in Europe. At least that's the spirit.
Let me ask about the contribution of AI, and not just to Meta, but all the companies that you cover at Madison and Wall. I mean, last year there weren't too many mentions of AI actually contributing to the bottom line if you went across S&P 500 earnings calls. And that seems to be picking up in this quarter.
Well, definitely for these companies and any of the digital advertising companies, it's driving so much of the growth. We estimate that about a quarter of Meta's ad revenue is coming from a product called Advantage Plus. Advantage Plus is like this kind of set it and forget it, make the creative on the fly, figure out where the ads go on the fly, everything's on the fly. For Google, that equivalent PMax, Performance Max, is a bit smaller, but this is where a lot of the growth is coming from. it drives performance the way that marketers want to see it. Again, whether or not it's really incremental is beside the point. But AI-based products are really critical for every digital platform, and increasingly for the non-digital ones too, like the traditional linear guys, the television networks like Comcast. They're not talking up the AI products. I didn't hear it on the call today, but their universal ads product would theoretically have an AI component for making creative for a small advertiser. So it is growing in importance for the whole industry.
I mean, just what we got from Meta last night just really amp up the bar for Google next week for Alphabet's earnings?
Expectations might be amped up. I mean, on the other hand, you look at Microsoft's numbers, which were a more reasonable, call it, whatever, 10% constant currency growth for the search and ads business plus for LinkedIn. That's probably closer to where the ad market is. With that said, Google is so big, they're so much bigger than Meta, that they grow at the industry's level. And so if the industry grew 10, it shouldn't be surprised to see them grow 10. For Meta to grow 20 when they're half the size of Google, well, I mean, it's a lot easier to grow faster from a smaller base.
Hey, Brian, this has been such an interesting conversation. Please come back again soon.
Anytime.
That is Madison and Wall principal Brian Wieser. Now, elsewhere in earnings this morning, Blackstone posting a surprise profit jump, deal making heating back up. Fourth quarter distributable earnings rose to $2.24 billion, helped by a surge in deals. I spoke with President and COO Jon Gray earlier to talk about what's fueling the rebound.
It feels to us like that 2013-14 period where after the hibernation following the GFC, we began to take a number of companies public, notably Hilton Hotels. And it looks like it should continue. As long as markets stay where they are, I think we will see a lot of activity. That's obviously good for us and our investors. I'd also point out for us that the decision we made to lean into AI infrastructure, becoming the biggest investor in data centers, becoming the biggest provider of private capital to utilities, the lead investor today in electrical equipment and related services, that's really delivered great results, and there's a lot of momentum there as well. And then I'd just say finally that we continue to see this secular shift towards alternatives. Insurance companies, individual investors, institutions. We had 71 billion of inflows in the quarter, 239 billion in the year. So a lot of good things are happening, but certainly the deal backdrop is quite favorable.
Whenever things are so good, people love to pick for holes in it and reasons they might not be good. John, there was a Bloomberg survey of private capital investors basically saying what could blow things off course. For them, it was macroeconomic or rate instability. For you, what is your concern that could blow things off course, and what is set up to be a strong year?
Well, you always can have things geopolitically. That's a risk that always exists. Certainly long rates, if you saw that back up, that could slow down the deal environment. But I'd say overall, the picture looks pretty good. We've got an economy with a fair amount of strength. Our private equity companies in the quarter had 9% revenue growth. That's obviously positive. We continue to see cost of capital coming down. Spreads are at very low levels. That's helpful for the deal environment as well. And then this AI world, this huge investment that's happening that we're helping to facilitate, and then the huge productivity boom that's going to come, I believe, after that is another positive. So there are always risks out there. You've got to be thoughtful on how you deploy capital. But the overall environment to us feels pretty good. I think this should be a strong year.
How do you navigate that AI spend specifically? Obviously, a huge boon to Blackstone. But on the other side, you have, for example, in public markets, Microsoft has earnings yesterday, and everybody freaks out that they're overextending themselves on CapEx. How do you find that balance of investing and capturing this new economy versus the fear of overextending yourself and bubble fears that emerge?
Well, I'd say how you invest really matters. So a lot of what we've done here is, as I said, this infrastructure, and it's based on long-term contracts with credit-worthy counterparties, and that makes a huge difference. So if you're building a multi-billion-dollar data center in the U.S. or around the world, and you have a 15-plus year contract with a company with a $3 trillion market cap, that feels pretty good. Similar dynamic if you're doing something around energy, be it an LNG or a new power plant, you have a long-term contract. So I think there are ways to do this that are more downside protected. At the same time, we're trying to capture the upside selectively. around some of the big LLMs, around some of the application software, but we're mindful of how much investing we're doing. We're also mindful of the risk, but there's also a fair amount of upside. I do think what's interesting is everyone's focused on these bubble risks. I think the biggest risk is actually the disruption risk. What happens when industries change overnight, like what we saw to the yellow pages back in the 90s when the internet came along, or what happened to Uber when Uber and Lyft came to the taxi business 10 years ago.
That was my interview with Blackstone President and COO Jon Gray. We'll have more of that conversation in the next hour. Matt, and I went on to ask him, okay, you're worried about the disruption of AI, and that's the biggest threat. What are you rethinking? And he said something we've had guests on the show talk about. Some of these IT companies, some of these software companies that are really set for disruption. There's a lot of private capital firms out there that have put so much money behind these companies, and ones that are specifically built just around them. What happens when that changes and AI eats their lunch?
Yeah, no, it's one of the biggest questions that I have, when we look at, some of them are huge companies, right?
Yeah.
And previously, the reason they're so big is because they had such huge margins. But those margins are going to get shrunk when people start using AI. Like Joe Weisenthal of the Odd Lots podcast is coding his own programs.
Yeah, he loves Claude, and a really interesting episode on that. By the way, we were showing a little teaser of it coming up next week on Wednesday. Follow the Money with Bloomberg Deals, my new show that dives deep into coverage of the biggest mergers, power players, private capital, and capital flows shaping global markets. Again, it starts next Wednesday, appointment viewing. But coming up in the next hour, we're going to talk even more deals, AI infrastructure with I2 co-founder Sadek Wahba.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger, and we just can't get there. We're so close to 7,000, but now we are on track for 2 consecutive days of losses, putting the index just above 6,900. Microsoft earnings, those dragging down the overall index, falling as much as 11% in the open. Will the macro data help us, Matt? We have some new breaking data crossing the terminal just now.
Yeah, I mean, these are pretty, 0.6 is pretty sincere losses on the S&P. So still 60 points away from 7,000. We are getting durable goods. We're getting factory orders. We're getting wholesale inventories. And whenever we get all of those things, we go to Michael McKee, Bloomberg's international economics and policy correspondent. He's at the desk with us. So, Mike, what do we know from this? Well, when this data comes out, what do we know from it?
Well, this is November data, so it's a bit old, but it was good news. Durable goods orders rose 5.3%. We kind of knew that because durable goods is reported earlier. So what we're looking for is the factory goods numbers, and I'm looking for that to come out right now. Give me just a second. Okay, factory orders up 2.7%, which is better than the estimated 1.6%.
Yes.
Take out transportation, though, and it's only 0.2%. So some of that is obviously Boeing and maybe automobiles. The interesting thing with the factory orders is non-durables. I don't have that number in front of me. However, we have had a good day so far in that the jobless claims numbers were pretty good this morning. The interesting thing is we had initially reported 200,000 jobless claims last week, and then that was revised up to 210,000. So this week we got 209,000. So instead of a 9,000 gain, it's a 1,000 drop. So we're still seeing very low jobless claims. But the interesting number, and I'm going to give you guys something you can do in the next hour here, international trade. The trade deficit comes in at $56.8 billion, the biggest jump since 1992, because we were at 29.2 in October. And the thing here is that with the very low deficit, it adds to GDP. And so remember, the Atlanta Fed GDP number was 5.4%. Everybody in the Trump administration is running around crowing about that. This is going to knock that down considerably. It'll still be strong, but it'll knock it down. And the next update from the Atlanta Fed is going to be coming out sometime in the next hour or so.
I noticed President Trump a lot of times lately will talk about nominal growth instead of real growth.
Well, these are real growth numbers. Yeah. We're not talking about nominal.
No, I know, but he'll say 7.
Well, of course, yeah. Nominally, you want to add in inflation, and I'm not sure that's the best idea when inflation is still above target.
All right, Mike, thank you so much for joining us this morning. Breaking down those numbers, that's Bloomberg's Michael McKee after putting in a long day yesterday on the Fed decision.
And he was here early. He was here for the brief as well.
Mike,
so
You were here. So, I mean, I can't claim
I think there's
any
like
kind
a collective amount of like one normal night's sleep between the two of you if we were to put them together. Thank you so much for your work and your early hours too this morning, Matt.
It was a pleasure.
Briefing us all. All right, one of the other themes we are tracking this morning is AI infrastructure. It's in focus with big tech earnings in full swing. I asked Blackstone President and COO Jon Gray about finding balance between investing in AI and bubble fears that have emerged from it.
How you invest really matters. So a lot of what we've done here is, as I said, this infrastructure, and it's based on long-term contracts with credit-worthy counterparties, and that makes a huge difference. So if you're building a multi-billion-dollar data center in the US or around the world, and you have a 15-plus year contract with a company with a $3 trillion market cap, that feels pretty good.
Joining us now is Sadek Wahba, founder and chairman of I Squared Capital. He's also the author of Build, Investing in America's Infrastructure, and one of the most trusted infrastructure investors on Wall Street after having started the Morgan Stanley business. In that, you know, Sadek, it strikes me, we talk to a lot of people who invest in data centers because Dani has such great connections in private capital, and that's where so much of the money comes from. But your upside is capped on these deals, right? And your downside doesn't seem to be unless you work in certain covenants. So what do you make of this, all this data center investing? Because it's hundreds of billions of dollars.
First of all, thank you very much for having me. You're right. Your previous speakers talked about data center, the potential upside that you can get from it. I think the real issue I see is that, is it something which is real? Absolutely. But I have a sense that the underwriting has gone ahead of the business model a little bit. So we have to understand the fundamentals, right? I was very interested by the fact that the CEO of Microsoft at Davos was really urging people to use AI. Everyone, all the consumers. So you really want to understand what are the fundamental demands. Is it here to stay? No doubt, right? Do we need data centers? Absolutely. My only issue is when people say, oh, I can have a 15-year contract with an excellent counterparty, AAA, and it makes it look as if it's a real estate play, down Park Avenue, right, with a big bank that is effectively your tenant. It's not exactly that, because you're not on Park Avenue, you're in the middle of nowhere, and then at the same time, you really have to look at that contract very carefully. So are there opportunities? Absolutely. Are we investing in these opportunities? Definitely. But I like to think of this as, in baseball analogy, really focusing on singles and doubles as opposed to hit a home run.
By the way, I love those comments from Satya Nadella at Davos. It was almost as if he was like begging the world, like, please use AI or else this whole thing isn't going to work out. But when it comes to the contracts, because I've had these conversations with a lot of people, Matt and I both have, whether it's Blue Owl, whether it's Blackstone, and you're spot on. That's the comment they say. We're not taking AI risk. We're taking Oracle creditworthiness or Meta risk. And they say these contracts, they are many years long. We are safe. Meta's agreeing to be a tenant for us. So where is the potential gap that some of these people aren't seeing where things could go wrong?
So to the extent that you have a contract which has price escalators and a full guarantee from the offtake, and you like the credit worthiness, yeah, that's something which is interesting. Then the question is, you ask, are the returns that I'm getting on this investment attractive enough from a risk perspective? Am I making 10% return or 12 or 15 or 8? For the kind of risk that you take, that's the question that you have to ask. So there is the contract as solid as you think? In many cases it is, in other cases it isn't. I'll give you a simple example. Is the price fixed for the 15 years, or do you have the right after 5 years to reprice the contract? If you have the right to reprice the contract after 5 years, you're good for 5 years, but you don't know what the demand will be 5 years hence, right? So if you have a fixed contract for 15 years with a price escalator, I'd call that a home run.
I want to pivot here to the dollar, because last week I was fortunate enough to interview you at the Aon TS Symposium in Miami in Biscayne Bay. It was lovely.
That doesn't sound like a bad place to be right now.
And there was a lot of talk about U.S. policy and its effect on the greenback because we just come out of Davos, and at that point the dollar had obviously it's come down to almost a 4-year low, but it's fallen pretty precipitously in the last week. What do you make of the drop in the greenback? What's driving this drop, or is it, as Dani said yesterday, which if you zoom out makes sense, just a normalization?
I've learned never to forecast either on the stock market or on currencies. As you know, 80% of what explains the movement in the stock market, if not more, is actually nothing, right? And no one is able to know what that means and to be able to forecast. From my perspective, you have to take a step back. The dollar over the last 3 years has depreciated about, call it something around 10% against the euro. It's flat relative to the yen because of what's happened in the yen in the last couple of weeks, over the last 3 years. Relative to the Swiss franc, it's down by 17%. And in my view, relative to gold, is down by 60%. That's a staggering number. So at the end of the day, you have to ask yourself, what is causing the dollar to devalue relative to the gold? So before, $1 could buy this amount of gold, $1 today buy much, much less, 60% less. That's a big change. And I think that is a change in sentiment with all of the uncertainty that's happening. Not uncertainty, by the way, in terms of US policy, but global uncertainty. Is the economy going to grow? IMF is predicting somewhere around 3.3 for a global economy. The US was 2.1, now 2.5. People are predicting something like about 2.6, 2.8%. Really, no one knows exactly. Interest rates, where you generally have a good, stable view, what's happening? Well, we think that there's going to be no rate cuts for the coming period until Chairman Powell leaves. After that, it's unknown. So there's a lot of movements, and it's no longer a question of data-driven. It's really sentiment-driven, among other things.
Do you think a big part of this, and I would love also to just get your view as someone who invests in infrastructure and has a mind globally, how much of this is also just dealing with continued volatility out of the White House, that maybe people have kind of been able to push some of the short-term noise aside when there are specific pronouncements about credit cards and housing, whatever, but on an aggregate level, creating some type of fear of an administration that is really happy to step in and attempt to dictate directions for corporate America?
Look, it's easy to blame or to attribute all of the uncertainty to the administration. I really don't agree with that, because at the end of the day, it's too facile to say this. I think there is uncertainty globally. Look, it's what's happening in technology. We are predicting every day a different view, right? In terms of the cost, in terms of the usage, in terms of companies' stock soaring and then coming down. So it's very difficult to be able to have a view. I would argue that in some of the policies that the US administration has done in the last couple of months, over the last year, actually has been beneficial. Yep. Everything to do with the onshoring, for example, of key businesses and manufacturing into the US, I think is a huge plus, because that has revived a lot of the industries that have a national security element to it. So that's extremely important. From an infrastructure perspective, what I like about that, if I may say, is that you're investing in real asset over the long run. So you try to avoid the distraction from political or regulatory issues and focus on the long-term need for infrastructure. Is that something which is critical? Is that something that is immune to regulatory change? Because the implied price elasticities of these infrastructure services is very low. People need it, whether it's a road, whether it's power. And that, I think, is what's interesting in this current uncertain world.
You're in good company, by the way, because that's exactly what we heard yesterday from Abby Joseph Cohen at Columbia, as well as Neil Dutta at Renmac. So, Sadek, great having you here. Thank you so much for joining us. And for last week as well. Sadek Wahba there of I Squared Capital on set with us, and after I spoke with them at the Aon TS Symposium. Coming up, Nasdaq reporting better than expected revenue in its latest earnings report. We're going to speak with the chair and CEO, Adena Friedman, next. This is Bloomberg Open Interest.
Nasdaq shares are rising after the company delivered better than expected revenue for the fourth quarter. Annual net revenue also surpassed estimates, coming in at $5.2 billion. Joining us now is Nasdaq Chair and CEO Adena Friedman. Adena, thank you so much for joining.
It's great to be here.
So many highlights in this, from IPOs coming back to your other fintech businesses, which are fascinating. But for me, the switching to the Nasdaq for certain companies like Walmart coming over, your numbers, a record $1.2 trillion in listing transfers. With everybody wanting to become a tech company, how many inbounds are you getting for more companies to make a Walmart move and become listed on the Nasdaq?
Well, first of all, thank you so much. It's great to be here. And we are really proud of the results that we delivered for the quarter and for the year, with 12% growth overall and 11% growth in our solutions businesses, with every part of our business contributing, including our listings business. And when it comes to transfers from the New York Stock Exchange to NASDAQ, we really focus on several different key differentiators for us. First is we are the home to great innovative tech companies, but innovators across every sector. And I think that's what's really come to everyone's attention, is that everyone is becoming much more tech-enabled. Technology is becoming an integral part of their innovation story. But you can innovate across industries, and these innovative growth companies gravitate to NASDAQ, including Walmart, which we're so excited. It's such an amazing company with amazing leadership. But we also have the index business. So we closed the year with $882 billion in our index business, $99 billion of inflows just in the year. And what that does is it allows us, through our partners, to become investors in these great companies through the Nasdaq 100 index franchise. And in the case of some companies, we could be as much as a 4% owner of their shares, which creates a really nice long-term passive ownership. In addition to the fact we also have market quality, we've invested so much in our technology to drive market modernization. It's showing up in the quality of our markets and the level of participation we have, which is actually become a real differentiator for us, and particularly with these mega cap companies. And then, of course, lastly, we have all these great marketing assets that we do to help promote their brand as an innovative growth company. And so all of those things combined has really created a great opportunity for us to talk to Shopify, to Kimberly-Clark, and to Thomson Reuters, in addition to Walmart, and bring them to NASDAQ in 2025.
So your first time over $5 billion in revenue. It's a record solutions sales growth, record index inflows. And the one part that I keep thinking about is the concentration. I've been thinking about it since I read your piece on LinkedIn, actually, more. Is that a risk that you're worried about, that there's so much concentration risk in these AI-heavy companies?
Well, I think the first thing is what we have actually seen is returns start to be more broad-based. With interest rates coming down, small cap companies, over the last couple of years, they've had as much as 40% of their net income have to be spent on interest expense. So as the interest rates are coming down and the cost of capital is coming down, it is allowing them to invest more in their business and deliver more for their shareholders. And you are seeing a broader-based return profile with large cap and small cap companies as we go into 2026, which we're encouraged by. But we also do have these great mega cap companies that are delivering the future of technology to every industry. And I think that as a result, the investment that they've been making is critically important, very large. Still, though, not even. It's about, if you look at all of the hyperscalers and the semiconductor companies that have really been investing heavily here, it represents about less than 70% of their annual cash flows in aggregate. So imagine how cash generative these companies are. So there's a huge ballast of cash capabilities, in addition to having very large scale investors like Blackstone be an underwriter of these types of investments. And I do think the public capital markets are going to play a bigger role. This investment is a change in the infrastructure of our economy. Right. And more of the industry experts are going to be coming in and delivering against that opportunity. So we see the capital markets playing a bigger and bigger role going forward.
Can I just follow up on your LinkedIn piece, which I thought was fascinating? I think your core argument is that this is not some kind of flimsy stock bubble. This is a generational sea change, like the railroads or the internet. But with the internet, it was both, an industrial shift and a bubble, right? Because I was looking at the Nasdaq high in March of 2000, and it took 15 years to get back there. Okay, now we're 6x that. But is it possible that we have the same kind of delayed, revenue problem that we had then?
So first, I would say I was at Nasdaq back then, so I've actually lived through that experience. And what a big difference here is that the companies that are underwriting the risk and the opportunity are very large-scale, well-capitalized companies. Number two, when you look at certainly the Nasdaq 100 today, the minimum market cap on the Nasdaq 100 today is about $30 to $40 billion, whereas back then it was like $5 billion. Yeah. And also, as you said, the revenue generation, if you look at companies that are coming public, these are revenue generating, really strong companies that have strong business momentum, KPIs, all of those things. And so as much as I do think that there's going to be a lot of investment here, I also think that there are going to be winners and losers, of course, or, as these trends come through. I believe that the underpinning of this investment cycle has much more capital and much more ballast that underpins it as we move forward. And it's a long-term trend. It's the future of our economy that we are underwriting right now.
One of the things that's also really transformed in markets, and I think how much your index business has grown is also a testament to this, is just a wider participation of investors, more retail investors, more happy to jump in the market. But a strange kind of stepchild has arisen with it, and that is the prediction markets. We had a guest on, Amy Wu Silverman of RBC, who framed it as a threat that maybe prediction markets grow and people go into there and less into equity markets. How are you viewing kind of the booming, I guess, asset class, I don't know what we want to call it, of prediction markets?
Well, I think, first of all, we are very clear that we view regulation as an important ballast and an important underpinning of markets, but really just for the purpose of investor protection and all the things that it comes with it, the guardrails that are really necessary to make sure that investors have a sustainable, lasting experience. When you are putting your savings to work and you are a true investor, the equities markets are an amazing opportunity to find returns. When you are looking at this more as a way to spend your afternoon, that's a different, it's a different investor type, it's a different use of capital. But also, even then, the rules have to be clear. And I think that's where we've been engaging with regulators to understand how are they thinking about shaping the rules. The CFTC and the SEC are working together better than we've ever seen before, because a lot of these prediction markets sit kind of in between. And so it's really a matter of how do we make sure that the rules of the road are clear so that investors are protected.
Adena, great having you with us on set today. Really appreciate you joining us. Adena Friedman there, the CEO of the Nasdaq. We'll be back with more on today's IPO, PicPay. Let's check on what's going on in the markets right now. A sea of red with the S&P 500 down to 69.26 after we crossed through 7,000 yesterday. The Nasdaq right now down 1 1/3% as Microsoft disappoints with cloud growth, 25,680, the level there. And you can see Microsoft getting decimated now, losing 11% of its value at 428.65. Coming up, another company that has been hit hard, ServiceNow, reported a beat, but investors are raising questions about how AI will impact the business. We'll hear from the CEO of ServiceNow, Bill McDermott, next. This is Bloomberg Open Interest. ServiceNow delivered a strong sales outlook, but shares are under pressure as investors weigh concerns about how AI could disrupt the software business. Bloomberg Tech's co-host Caroline Hyde joins us now with the CEO, Bill McDermott. Caroline?
Matt, thank you so much. And Dani and Bill, welcome. What more is a man to do? You delivered 21% revenue growth, a positive guide. Big M&A is not on your roadmap, you say, but still this anxiety lingers. Push back on the move in the stock for us today.
Well, I think the most important thing is to level set what ServiceNow is all about. First, it's the fastest growing enterprise software company of all time. First to $1 billion, 5, 10, and now 15 billion plus. So that's fantastic. And we're operating at the rule of 55. They say you're world class when you're operating at the rule of 40. We're now growing revenues more than 20% and free cash flow at 37%. So it's actually a rule of 57 company. And we gave a guide that blew away everyone's expectations. So I think the key is this. We're in a category of one, and we're playing a different game. And right now, the disjoint between that successful company and the compression of the multiples is simply Wall Street putting ServiceNow in a SaaS neighborhood with other SaaS companies where they think that AI can rewrite those programs. AI can't rewrite our programs. In fact, AI makes us better, and we make AI better. We've been building AI into our model for 7 years now. We have 80 billion workflows in flight today, doing 6.5 trillion transactions. That's pretty hard to rewrite overnight. Yeah. So we're beautifully positioned, and we just announced partnerships with OpenAI and Anthropic because they understand the meaningful difference between giving enterprise access to an AI model and building that model into workflow where real decisions are made. So it's actually a win-win, and the market hasn't caught up with that story yet, but they will.
I'm going to nitpick here. When will analysts start saying, okay, revenue will grow not at 19% for fiscal 26, but at a 21% that you just delivered for fiscal 2025? When will it look out that we'll still see more than 20% growth or an acceleration in revenue growth based on how much you're working with AI to hasten the business?
It's a wonderful question because we're the only one, one of the other concerns was, are seats compressing? Meaning, do you have less people buying your seats on a licensed basis? And our active users are actually up 25% when all the other ones are actually going down. Secondly, we put a hybrid pricing model in place on our AI platform, and that enables the customer to not only get the predictability of the seats in their budgeting process, but also on their business casing as we give millions of assists with our Pro Plus version. Once they run through that, they reload the tokens. Now, that token reload has already started because we've been at this for a while now. So as those tokens kick in, you're entirely right, we could see a huge hockey stick in the formation of our profitable revenue growth on top of the seat-based pricing model. That's why I couldn't be more confident in the positioning of the company, because the customer alone determines who wins and loses. Yeah. And guess what? Yeah. They're choosing ServiceNow at a record clip.
Bill, you're saying you've got organic growth. And I think many were worried that you were buying growth, inorganic growth. In particular, you were looking at large-scale M&A. But you pushed back on that yesterday passionately. You were saying, the worry is gone. You can give us back our market cap. When are they going to give back your market cap, Bill?
Yeah, if I may, Caroline, just explain to the investors. Please. So what happened was we acquired MoveWorks in April of 2025. It didn't close until December. Okay, so we had to wait 9 months for it. When that closed, we also announced 2 tuck-ins, one Veza, which was all about identity management, and one Armis, which is all about operating technology. And if you combine those things with the ServiceNow platform, it's a knockout punch, and it gives the customers a security profile that they need for an agentic AI world. But it came in succession. So the investors could have easily said, is he buying it like all the other ones do for growth? Well, I knocked that out of the park yesterday because we didn't have them in our reporting, and we still blew out the numbers. We bought them because it increases our TAM from 90, then 250 billion up to 600 billion. So we're going after a much bigger prize now. We are the enterprise software company of this generation. We are not a tools company, and we are not a functional software company. We are a platform company with apps that run across the entire enterprise that actually connect to the hyperscalers, the language models, all the data lakes, all the systems of record. And now we have security in our profile where the customer can get it all in one platform to transform their business and really drive agentic AI for better margins and better revenue growth.
Forceful. And I think many would say sometimes it just needs a sentiment change. And I'm going to go macro now, because with you we can. You're a globally minded CEO with a global business. Does the dollar matter? Does dollar weakness matter?
It really doesn't matter. You know, currency comes and goes, but the capital markets adjust for constant currency. And it actually gives us an advantage in some ways where you get a little bit of a tailwind on the reported revenues. But the big thing about scale and globalization, we've been very well known for a wonderful public sector business, federal, state, and local in the United States. That is now scaling, especially to Europe, where we're up 80% year on year, because the European governments and now the European markets are saying, hey, we've already played the old school game of doing things the way we always did them, and we're getting what we always got. We want something different, and that's where ServiceNow comes in. And again, I go back to, it's not an old school system, it's not a tool, and it's not a functional system. It's really a platform that transforms business and delivers ROI quickly. Customers today in the public or the private sector don't have time to wait. We get them live in days and weeks, sometimes months if it's a huge one, but not years and years. So we've changed the game. This is a little bit like looking at the best opportunity you've ever seen from an entry point, and you're going to either deny it or you're going to jump in. I, for my part, am jumping in. That's why I announced yesterday that our board approved a $5 billion share repurchase, and we're activating an ASR early next week, because that's when the open window exists. And we're putting our money where our mouth is. We've never seen a stock opportunity like ServiceNow's, and we're moving on it.
It's management belief in the stock story. Talking of management, you're a man who's all about the people, Bill. I know this. Can I ask a sensitive one, just briefly? You've got some people in Minneapolis, in Minnesota in particular. You've got a co-working space. How have you been there, speaking to them or supporting them at this time? What have you been making of the recent activities in Minnesota?
Yeah, well, it's interesting you mention that, because when I enter the door leaving your interview, I'm meeting with the entire company called ServiceNow, and something we call ServiceNow Live. It's an amazing meeting run by our Vice Chairman, Nick Zitzen. He's amazing. And we're going to talk to all of our employees in a very personal way about those events and many other events that are going on around the world. We put AI to work for people. We have a bias for people in the company, and we really care. So we have assets on the ground. We're really getting in front of understanding the investigations, the outcomes of these kinds of things. And we have a huge heart at ServiceNow. So every single employee in our company is going to get to feel that in just a few minutes, Caroline.
We appreciate you for your time today, Bill McDermott, on the earnings story, on the people story, ServiceNow CEO and Chairman.
Caroline, thank you so much for bringing us that interview. Such an interesting time for the sector as a whole, and I'm sure this is a conversation you're having frequently on Bloomberg Tech. What happens with the disruption of AI to companies like ServiceNow?
And look, you're front and center on saying everything's a tech business now. The Dow News, 4,500 people going because of AI. This is a people story as much as it is about how software is under pressure, but also how some of the tech titans in CapEx is only up and to the right.
Yeah, and then we had a conversation with Adena Friedman that everyone wants to be a tech company is going to the Nasdaq too, which is another great reason to watch your show. Caroline Hyde, thank you so much, co-host of Bloomberg Tech, which kicks off at 11 a.m. in just 20 minutes time. Let's get a check on your markets this morning, and they're falling. It's a tough morning to be a tech company, specifically if you're Microsoft. Fears of AI spending. Oracle also tumbling this morning too. That is the narrative. Can you spend, and can you back it up with cash flow? Down 1.8% for the Nasdaq, 11.6% for Microsoft. Coming up, we're going to talk more about the Nasdaq, specifically a major Brazilian digital bank making its U.S. debut on that exchange. PicPay CEO is going to be joining us next. Stay with us for that.
One of Brazil's biggest digital banks is making its U.S. market debut. PicPay raised $434 million in its IPO and is set to trade under the ticker PICS on the Nasdaq. Shares are indicated to open at $20 above the IPO price of $19. This is the first significant debut for a Brazilian company in more than 4 years. Joining us now is the CEO of PicPay, Eduardo Chedid. Eduardo, thanks so much for joining us. You know, I was watching you ring the opening bell there, and I think the first question a lot of people are asking is why would a Brazilian company, a Brazilian bank, want to use the Nasdaq for an IPO? What pushed you towards that decision?
Definitely. Well, good morning. Thanks for having me here on such a special day. Well, just so people understand, PicPay is a large digital bank that operates out of Brazil, still with a huge growth opportunity ahead of us. We currently serve more than 66 million customers. Our revenues in the third quarter of 25 reached around 7.3 billion reais, around $1.4 billion, growing 92% year over year. And net income also trending 82% increase from the previous period, also with an ROE of 17.4. Well, Nasdaq, first of all of our peers, digital peers, are here. We wanted to access a larger base of investors and partners. And well, it's after 4 years of no IPOs in Brazil, we are actually breaking the ice and coming to the market. So we're really happy.
Yeah, I believe the first Brazilian IPO in New York in over 4 years. Eduardo, back at home, though, you do have a competition with one of your peers that is listed here in the U.S., and that is Nubank, and that's a CEO I've spoken to before. They still remain Brazil's largest fintech company by market value. You also have additional competition threats from big international players. What do you make of the state of competition and how you keep the competition at bay and potentially grow beyond them?
Well, I think that competition is welcomed, and Brazil is one of the most dynamic financial markets globally. It's not by chance that we have so many good digital players there. Yes, there will be more challengers. There will be the current ones. The incumbent banks also are doing a great job. I think that in the end of the day, it's all about actually delivering really good services and products, and PicPay is really well known for its product velocity as well as innovation. We've started in 2012 by basically pioneering instant payments in Brazil, long before real-time payments became standard. PicPay was already enabling millions of customers to move money instantly, digitally, and as well as in a very efficient way. So it's all about keeping up with all that product velocity and being able to continuously innovate and through solutions that actually can make a meaningful impact on the everyday lives of our customers. And PicPay has been able to do that so in the past few years, and turned a digital wallet in a full-fledged digital bank. So we'll keep doing that.
Hey, Eduardo, what is the economy of Brazil like right now? It's not, runaway inflation. You do have a relatively tight labor market. You have a growing GDP. And how does that add to your business model? How does that help you to grow revenues?
Yeah, we're really positive on the Brazil macro. I mean, we're the lowest unemployment rates historically. GDP growing this year. We'll also have an additional injection there, basically because lots of more people will be below the bracket from which you can get tax exemption. So we're positive. Interest rates are possibly going down as well. We're really happy and bullish on what can be done this year.
Hey, Eduardo, thank you so much for joining us this morning. Congratulations on the IPO, Eduardo Chedid of PicPay. Now, let's get a quick check on markets, because something painful is happening at the moment. You can see what both the S&P 500 and the Nasdaq is doing. The Nasdaq is nearing losses of 2%. But on top of that, metals getting hit so hard. Gold down more than 4%. Silver down more than 6.5% this morning. Michael Ball, our MLive strategist, making the point to me that maybe this is something having to do with CTAs. Cross-asset correlation is on the rise. Metals have become a momentum play. Maybe this is everything selling off and is more than just Microsoft earnings or fears in Iran.
Yeah, it is a fascinating move, the size of it alone, but especially in gold, which this morning was coming up through 5,500, and people were already talking about $7,000 ounces of gold. It can't be explained away simply by the Microsoft slowdown in cloud sales growth, because even that wasn't a big miss. But maybe the CapEx is starting to worry people across Mag 7 companies.
I think this should also bring to question, if gold is your hedge, what happens when it has painful reversals like this? If it is a momentum play and can drop almost 5% in a day, is it really such a good hedge?
Correlation's a B. Coming up, Blackstone's president says the biggest risk in AI isn't a bubble, it's disruption. More from Dani's conversation with Jon Gray next. This is Bloomberg Open Interest.
Blackstone president and COO Jon Gray warns that the real danger in AI is how fast it can upend whole industries. I sat down with him this morning to talk about AI disruption and how Washington policy is complicating the investment landscape.
There's definitely more risk in certain industries. There's no question that you have to think about some of the lower value IT services businesses, some of the businesses that are intermediaries where you may have these agentic agents, these agentic commerce happening, which could change the way we do things. I do think looking at each business is really relevant. And when you think about things like software, for instance, is it a vertical software that is sort of the system of record for a business that is very hard to rip out? Or is it some low-level horizontal software where it's easy to change and therefore the AI could lead to a big erosion in your business? And so every deal that we're doing today, in the first 2 pages of the memo, we're saying, what is the AI risk? Now, if that is, a quick service restaurant chain or an apartment company, there's lower risk. But there are plenty of businesses that are facing real challenges, and we want to focus on that. We want to look at our existing portfolio in the same way. And I would also say that it's not static, because if you buy a business that has real incumbency and they can transform to become more efficient using AI, they can end up being a winner. So I think awareness around disruption, awareness of change is so important. I do think it's one of the competitive advantages in the U.S. I think the adoption here is going to happen quicker than the rest of the world.
And you've mentioned this, the productivity edition of it. Goldman Sachs' David Solomon was talking to Bloomberg and said that the impact on Goldman means that talent growth is going to be slower than it had been in the past because of the productivity ad. Is the same going to be true for Blackstone? Short talent growth, but will it be slower because of the technology you're adopting?
We're a fast-growing company. It's hard to say. I do think in certain areas you could see greater efficiency. This AI gives our folks in some ways sort of superhuman capabilities. It's making our software engineers twice as efficient. It's making our cyber monitoring people 30% better. We're starting to use it in some of the legal areas like marketing compliance. But at the same time, it's allowing us to also assemble data and do things we couldn't in terms of content creation, looking at all the streams that are coming from 270 companies, 13,000 pieces of real estate. So, it may have an impact. We're a firm that doesn't have a ton of people relative to some of those other bigger companies, but I do think there will be efficiencies out there, and that is going to lead to, I think, generally higher margins in a lot of industries over time.
I think we're all going to be looking forward to your first AI-produced holiday video, a highlight of everyone's end of year. Jon, just on a more serious note, I can't let you go without asking about the disruption coming from policy in Washington, D.C., be it a government shutdown that delays deals or IPOs, or pronouncements from the president on social media about things like investing in housing or new tariffs. The policy we're getting, how much friction has it introduced into your investment process?
Well, often there are issues that come up. A number of them, get resolved over time. And we've generally counseled patience with our investors. We talked about this after Liberation Day. Let the tariff diplomacy play out. You can get worked up. We saw this around the Greenland situation, which ultimately came to a resolution. So I think the key is to take a longer-term approach, see where these things land. In some cases, it can impact businesses, and therefore you have to adjust in a certain way.
That was my interview with Blackstone President and COO Jon Gray. He did go on to say that, especially when it came to housing, affordability was clearly an issue. But you got to feel for them. I mean, their exposure to single-family housing is pretty small in the grand scheme of the behemoth that is Blackstone. And their shares plummeted when that came from the president. It's something that the entirety of corporate America has to deal with. What is the president going to say that could rock your share price?
Yeah, even though it makes up such a small part of their portfolio. Great interview. He's also one of the sort of young philanthropic leaders on Wall Street. So always good to hear from Jon Gray and how his business is doing. But more importantly to me, your deals show, your new program.
Oh, funny you should
premieres
mention.
next week.
It does on Wednesday at noon Eastern, 5 p.m. if you're in London, Hong Kong. You better be waking up at 1 a.m. to watch it.
Set your DVR.
Yeah, oh yeah, that too. I guess you could get some sleep. It's going to go in depth into all of these topics, Blackstone and beyond, Matt. I'm super looking forward to it.
Yeah, I'm looking forward to it as well. Coming out tomorrow, David Lefkowitz joins us, as well as Emily Bauer Sock Hill, plus Tim Long of Barclays. This is Bloomberg.